Hi, and welcome to the August 2016 Downtown Pittsburgh Investors Business Daily Meetup. My name is Eric Rossi. I'm a co-organizer for this group. And on the title page here is a link to our meetup group. So if you happen to have found this group through YouTube, which I know a lot of people are doing that, and you want to actually join the meetup group, there's a link to do so. And I also have instructions at the end of the presentation about that. So the group's mission statement is to educate individual investors about the CAN-SLIM investing strategy. And this is a strategy that was developed by a man named William O'Neill, who's the founder of IBD. So this really means identifying the best educational material, whether that be books, articles, webinars, etc. And this presentation is for educational purposes only. I'm not providing recommendations to buy or sell any securities. Investing in stocks does carry substantial risk, and you can lose your capital. I'm a non-professional volunteer investor. Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily, Inc., and Meetup is a registered trademark of Meetup, Inc. Topics for this month. First one is the market dashboard, which we always do first. Then I'll go through IBD, one of the features of investors.com. Then we'll talk about Buyable Gaps. Then we'll go through a market analysis, and then I'll cover some recent trades, and then we'll conclude. Okay, the market dashboard. First, the big picture right now is uptrend under pressure. So I'll give that a yellow. That went pretty recently, within the past couple weeks, went into uptrend under pressure. Actually, within probably the past week. And the uptrend health, we've been in an uptrend now for 65 days. At least using the market pulse as our guide there. So when the market pulse went from correction to uptrend is when I started this. So 65 days, we're pretty deep into this uptrend. This uptrend is up 8.4% on the NASDAQ. So the later we get into these uptrends, the more likely a pullback is to happen. And furthering that argument, we have right now 6 distribution days on the S&P 500, 4 distribution days on the NASDAQ. The distribution day is a day of distribution in higher volume than the day prior. So 6 on the S&P is a pretty high count. When we get up to 10 is a really high count, and we usually go into correction around that time. So 6 isn't the end of the world, but it's definitely higher than you like to see. I prefer 5 or less. The Fed activity. So the Fed raised interest rates in December, and they've been talking about potentially raising rates again, but not making any definitive moves yet. So the most recent commentary from Janet Yellen is that it sounds like they're going to raise rates one more time before the end of the year, but don't hold your breath, because they've always seemed to have some excuse for why they can't do that. So anyways, this gets a red because rates are rising, however, albeit how slowly it's happening. The S&P 500 right now, we're trading above the 50-day moving average. Year to date, you can see positive performance, and you can see that it's outperforming the NASDAQ year to date, which is a little unusual in recent years. So the IBD assigned an accumulation distribution of a C+ to the S&P 500, so I'm giving that a yellow. The NASDAQ gets a accumulation distribution rating of D+. And then the IBD 50, which is a composite index of the top 50 stocks in Investors Business Daily. This one is a little more subjective in terms of how I rank this, because they don't assign an accumulation distribution rating to this. But right now we're trading above the 10-week and 40-week the major moving averages. You can see the IBD 50 is up for the year. Its performance is between the NASDAQ and the S&P 500. This usually is going to track closer to I usually compare it more to the NASDAQ, since I think more of the stocks come from the NASDAQ than the S&P. And we've actually had some recent up weeks on the IBD 50 in above average volume. So I'm giving that one a green. And then these are unchanged from last month. Our last bull market, the current bull market started in March 2009, so we're very far into this. In fact, it's the longest running bull market cycle, at least in the past 35 years. And I talked about that in another presentation a few months ago. The last bear market ended in February 2009. Again, this is the longest period we've gone without a bear market correction since at least 1970. So we're kind of in unprecedented territory here, and I think this is happening mainly because the Fed keeps talking about raising interest rates, and then instead of acting on it, they keep changing their mind and they keep making excuses. So I think investors, I think institutions right now don't necessarily know what to do. And mutual funds have to stay vested. Many of them, they can't go into cash. They have to stay in growth stocks, for example, or they have to stay in foreign stocks. So the fact that they can't go into cash, they have to stay vested. The Fed is still uncertain about what they're going to do and then the speed at which they're going to do it. So all of that, I think, is contributing to the market just keeps quantitative easing is kind of limping the market along here. It's certainly not market's certainly not being driven higher by strong earnings growth in general, because IBD's had some articles in the past couple months about how earnings growth is actually on the decline for overall. And then intermediate corrections, which are corrections within the NASDAQ that are not characterized as a bear market. We've had 9 of these since March 2009. This is a very high number as well. So we get a yellow, red, red here. So you can see overall we've got probably half reds, some yellows, and only like 1 green here. So I think it's okay to be investing right now. I think it's not a time to go super aggressive in terms of investing a large chunk of your portfolio in growth stocks, but I think investing a portion of it that you're comfortable with, you could say 25%, 50%, whatever, and maybe you want to do some more day trading or swing trading rather than longer term position trading. Okay, the IBD feature of the month here. This month I'm covering the Investing Action Plan, which is a relatively new feature from investors.com. And what this is a daily report, and it provides useful information to help you prepare for the next trading day. So this is all about getting you ready to take action for the next day. And the plan may include a list of featured stocks that are reporting earnings either after the market closed that day or before the market opened the following day. So that's really useful to know. Definitely you need to know when your stocks that you own or anything on your watch list is going to report earnings, because that can be oftentimes a catalyst for either an upcoming advance or decline. And you definitely need to manage that. Also, I like earnings season because you can watch for buyable gaps, which I'm going to talk about a little later here. And those can oftentimes be high probability trades that can lead to some nice gains. And the Investing Action Plan also tends to include a list of economic reports that are due the next day. So if there's farm payrolls due, or the Fed's going to talk, or the European Union's doing something, then they tend to talk about these things. So this is what it looks like here, the Investing Action Plan. And if you were to scroll down, you would see as an example here, here's some stocks that they're talking about that are on the action plan. And they'll say, hey, Broadcom, for example, here's what analysts are expecting in terms of the earnings report. Here's what the prior quarter was. Here's what the stock itself is doing. And then they'll typically say, oh, well, this stock is reporting earnings after the market closed today. Okay, next topic is buyable gaps. And IBD sometimes calls these breakaway gaps. I like the term buyable gaps personally. It's just a personal thing. So these are basically gap ups in the stock price that occur after prior constructive action. And some factors to evaluate gap ups. One is, how constructive is the price action before the gap? So if the stock is trading in a relatively narrow range, tight trading, particularly in light volume before a gap up, that's very constructive. If the stock is in a base and it then breaks out of that base on the gap up, that's very constructive. If the stock has been on a tear recently, if it's been up significantly and is almost going parabolic, a gap in that case is not buyable because that actually could be a sign of a climax top. And if you want to read about the characteristics of a climax top, go to Bill O'Neill's book, How to Make Money in Stocks, and he'll give you some criteria to help evaluate if it's a climax top or not. How extended is the stock before the gap occurred? So that goes along with that discussion I just said about if the stock has been running up over a few weeks and it's been even having some gap ups within that time, and then all of a sudden we have this big gap up on an earnings report, that might not be the best place to buy, because as these stocks get really extended from the moving averages, pullbacks tend to be coming shortly thereafter. So it makes the Buyable Gap a lot more risky than if the prior action was sideways trading or a slight downtrend before a Buyable Gap up is okay. If it's a sharp, steep sell-off before the Buyable Gap, that increases the level of risk. And if it's a sharp increase in price before the Buyable Gap, that also increases the risk. Another factor to consider is how large is the gap in price compared to the stock's average true range. If you're not familiar with average true range, that's a measure of the stock's volatility, basically. And a stock that is more volatile, and an example that comes to my mind right away is a stock called Urende, YRD. That is a very volatile stock. It trades, you'll often see it up 10% one day, down 6% the next, up 12%, down 5%. Okay, that stock is going to tend to have a high average true range compared to a stock like Amazon or Facebook that tends to be trading maybe 0.5% up or down on average each day. So the point here is that if you have a really volatile stock that gaps up, but the gap up is basically a normal move, then it's not really a viable gap, okay? Or it increases the risk of it. So you want to see a gap move that is bigger than the average move, okay? And on IBD, I haven't seen anywhere where they provide average true range. You can find it on other websites. I know MarketSmith, you can find a 30-day average true range, and you can find it, I'm sure, on other, possibly through your broker or through some other free services. I'm sure you can find it. So if you want to have some criteria for what is a good Buyable Gap, you can look at this yellow book down here, Trade Like an O'Neill Disciple. And in there they have a definition which ties in average true range. So I'm just going to read the definition here. It says, they define a Buyable Gap up as follows. The stock gaps up at least 0.75 times its average true range over the previous 40 days. The second criteria is that volume on the gap up day is at least 150% above average, and that's a 50-day moving average of daily volume. So if you use the chart service on investors.com, the volume percent change is always provided. You won't be able to get average true range from there, but it's better actually than, instead of calculating how big the gap is compared to the average true range, it's actually better to just learn to do it visually. So this red book down here is basically a workbook to follow up the yellow book. And in the red book, they give you the average true range and the percent volume change for a couple gap ups as examples. Then they give you a bunch of examples without those numbers, and they tell you just visually, does it look like a Buyable Gap or not? And how good does it look? So that's, if you want to learn, I think it's best to just learn it a little more visually. Both of these books are good for that. I would start with the yellow book, and in the yellow book, which I have in front of me here, Buyable Gap ups are in They're on page 165. Chapter 5, 165. So I would start with the yellow book and then go over to the red book. The red book is more of a workbook where they have examples and you can see a bunch of buyable gaps and you can write down your thoughts about them, and then the authors will talk on the next page about their thoughts, and you can compare, did they have different thoughts or see some different things than you did. All right, the next item to consider is how large is volume on the gap day compared to the 50-day moving average volume. So you want volume to be at least 150% above average, and that one's pretty easy to find. You won't necessarily know that first thing in the trading day because you won't know what the day's volume is going to be until the market closes. But often on these gap up days, you'll see a stock maybe trading a full day. It'll trade the average daily volume in the first couple hours. And in that case, you know that volume is going to be huge for the day. So you can conclude early in the day that, yeah, this meets the volume criteria. Another thing to consider is where does the stock close in the daily range? So on a gap up day, there's no right way of talking about of determining when to buy these. You could buy it at the market open, and you're potentially opening yourself up to more risk because you have no idea what's going to happen after that. You can wait till the middle of the day, which is what I tend to like to do with these, because then you've got a little bit of action established for the day to get a better idea of where the stock is going to potentially close. Or you could wait till the end of the day, is probably the least risky approach. And ideally, you want to see if a stock gaps up, you want to see it close near the top of the daily range. Okay? If it trades really high in the day's range and then reverses and closes at the bottom of the range, it generally is not as strong of a gap move, and it probably isn't going to work out. It probably isn't going to result in a huge run-up in price afterwards. Another factor is, did the stock make a new price high? So if the stock is in a long consolidation and it's far off of the 52-week high and it gaps up, it still has all this overhead resistance to overcome. And that tends to make the gap move less strong. And Mobileye is a good example of that. And in fact, we'll look at that one here. I'll add it to the 4. Whereas if the stock gaps up to a new price high, like Acacia Communications did when they reported earnings, it gapped up significantly and traded it and closed at the top of its range. Volume was massive, and it made a new price high. That's a really strong sign. And Acacia did go on to keep moving after that, keep moving up quite a bit. And the last factor here is, did the stock break out of a consolidation? So gap moves are, in my opinion, I like to see the stock making a new high on the gap move, and I like to see the stock breaking out of some price consolidation. Whether that price consolidation meets the definition of a cup with handle or a flat base, to me is less relevant, as long as it's breaking out of some constructive consolidation. And as I mentioned here, if you want to learn more about buyable gaps, I recommend starting with the yellow book. There's not a whole lot written about buyable gaps in the book, but there is. I didn't see anything in Bill O'Neill's book about this, so that's why I'm pointing to these two instead. The red book has a lot more. They have there's probably like 30 example charts where you go through and you mark up the chart with your thoughts on the buyable gap, and then you can compare it to the author's notes, which is really useful, I think. So let's look at these examples here in MarketSmith. The first example is eBay. Okay. So if we start on the weekly chart here of eBay, eBay recently had a gap move in this week, okay, which you can see closed at a new 52-week high. It might not be an all-time high, but it's a new 52-week high. And you can see that previously the stock was hitting resistance around the $30 mark. Okay, so the fact that it gapped and closed above, or ended up closing above this level for the week, is a good sign. And you can see that it is continuing to move higher, although it's been a little slower. So you want to look at the prior action to see, is the gap move, is it moving into new high ground, at least new in the past 52 weeks. So if you look at this day, this is the gap day. You can see here, this was the day of the earnings release. So between the market close here and the market open here, there was an earnings report. Okay. You can see the average move here without calculating the average true range. You can see what the average day looks like here. Okay? And you can see how this move is just huge comparatively. Okay? Something else that you can consider here for buyable gap ups is you could actually draw a line from the prior day's close all the way up to show the, you could consider this the effective range, the effective trading range for this day. And that can be useful if a stock closes in the lower half of the range, because you might still see that it closed in near the top of the effective range, is what I call this. Okay, so this is that's a little trick you can consider right there. Draw a line from the prior day's close to the top of the gap day's range. Okay, but either way, this stock finishes high in the daily range. Okay, 75% according to this range right here. So the fact that it does that, it ends up closing just above this prior high right here. Okay, I'd like to see it close a little more decisively above that. But the fact that this closes high in the range, it comes out of this, this consolidation right here. Now it has been moving up prior to then, but it's moving up within this overall consolidation. So that's constructive. This certainly isn't a climactic type move. So in my book, when I saw this buyable gap, I thought this was a good one. And what you can do is, if you're going to buy this day, you can use the low of the day, so 28.79 here, as your stop. So you could just say if the stock closes below that level, you're going to sell it. That's where you're going to cut your losses. Now it depends where you buy in the daily range. You might not be able to do that. If you bought at the top, you're going to have to set your stop somewhere else. If I bought above this point, above 30, I would set 30 as my stop here. But in this case, you can see this worked out. It moved up maybe about 5% over a few days, and then it consolidated a little bit. It did pull back here in low volume, okay. And then we had a pocket pivot day here where it moved back above the 10-day moving average and above in volume that was higher than the prior 2 weeks. A pocket pivot is another buy point that's discussed in the two books I just showed you. It's not an IBD thing. It's a Gil Morales, Chris Catcher buy point. And you can see this thing is moving higher now. It moved above this prior peak of 31.79. So if you bought the gap, you'd be up in the neighborhood of 10% right now. I would probably go take my profits pretty soon on that, because this is I like these buyable gaps more for a swing trade than for a position trade, but that's just me. You could certainly use this as an opportunity to build a full position in the stock and invest in it for a little more longer term. Okay, so that's one. So that's a good buyable gap in my book. Trex is another good one. All right. So Trex recently gapped up on an earnings report. You can see that the prior high here, around 58 in the past year and a half. And where did this close? This closed a little below that, but this closed at a new high in the previous year. Right? This was August. And here's August of last year. So this clearly made a new high in the past for the past 52 weeks, which is very good. You can see too, this also came out of this long consolidation, this long cup with handle, very long cup with handle. I actually would call this a double bottom because this low, yeah, this low undercut the prior low. I would call this a double bottom personally, double bottom with handle, but Market Smith is calling it a cup with handle. That's fine. So this here, Trex broke out of a base. Okay, it broke out of a base here, made a new 52-week high. It closes high in the daily range. Volume is huge. Volume is 600% above average, which is a huge spike in volume. So again, this was another one I saw. I was full. My portfolio was full for both eBay and Trex, so I didn't buy either of these. I wanted to, but I only trade so many stocks at a time. But you can see that this one, you know, even if you bought this at the high of 58, you're up maybe 8% now. And if you would have gone for a 10% gain, you might have gotten it here. You might have been able to get that right on this day. But it's still holding the 10-day moving average, so you could also hold the stock and wait for it to break the 10-day moving average. That's another, I think that's a sound strategy for a swing trade out of a buyable gap like this. And this also came out in an earnings report. So that's a good one. Let's look at Facebook. So Facebook is an example of some buyable gaps that have failed recently. All right. This day here was a gap on the earnings report, and I actually bought this stock right here. I was looking at a trend line right here, and let's see if I can turn this off. Okay. So I was looking at a trend line here on this, which it broke the trend line this day. So I did buy Facebook this day, and I was feeling pretty good about it for a few days, and then it failed, and I ended up selling. I believe I sold on one of these 2 days when it, you know, I had like a 5% gain here. So one of my sell rules is that if a 5% gain on a stock turns into a 1% gain, then I'll sell it before it turns into a loss. So you can see what happened here. This gapped up. Volume was huge, and it almost made a new high within what I can see here. But then it made a high the next day in a heavy volume too. So this was looking really nice. And then you can see it just sold off on heavy volume here. So this gap filled, meaning whatever the high price before the gap was hit these 2 days here. So that's called filling the gap. So after that, it did move back up for a while. And then we had another gap right here. Okay, and I think I bought this one too as they reported earnings. And you can see this one was not so good. This closed at the bottom of the daily range. Now, you can use our vertical line trick here. So if we consider this whole thing here the day's range, we did probably close in we closed in the top half for sure. Maybe I'm just eyeballing it like maybe 75% of the daily range. If you really want, you can calculate it, but I don't think it's necessary. And then this one you can see, you know, if you would have when I use these buyable gaps, I tend to use the intraday low as the stop. You can see that it basically held that for a while here, and then it lost it right here on this day. And it also went below. This was a gap down day. It closed below the 50-day moving average. Volume was heavy. So if you did buy this buyable gap, I would have got out of it right here for a small loss. So these are a couple examples of ones that just didn't work out. Mobileye was another one. So Mobileye had a gap up right here, which I bought this. I love this stock. I've been watching it for a long time, and I've been waiting for it to do something, and it's screwed me over, like you see here, 3 times this year, so I'm not trading this thing again. But some of that, I mean, part of this, I think I mismanaged this initial position here, but anyways, I bought this breakout, ended up selling on this day as it closed below the pivot, and then then 3 days later the thing gaps up 10%. Sometimes that's just the way it goes. But this gap up move, you can see it finished low in the day's range, and then it did fail shortly thereafter. And then you can see they had another gap up here, which failed and came back and filled the gap there too. Now, part of the reason for this is that if you look at these buyable gap ups in terms of the overall, the greater on a weekly chart, the greater consolidation here, you can see how much this is all overhead resistance up here. So there's people that bought up here that are still holding the stock and are just dying to break even on this thing and sell it. So as a stock like this moves up, it tends to hit a lot of selling pressure as people who bought up in here sell their shares to break even. So this thing has quite a bit of still quite a bit of overhead supply to go through, and it's part of the reason I think that it's not quite these gaps aren't quite working on Mobileye. And the last one I want to look at is Edward Life Science. So this one here, you can see we had a gap day here. There had to be some kind of news event here. I don't know what that was offhand, but could look it up and find out. It had to be. It was probably something related to one of their medical products getting some kind of approval. But you can see this gapped up, huge volume. It didn't occur in an earnings report, which is kind of unusual. Usually they occur on earnings reports. And then you can see it moved up higher for a while, and then the stock consolidated. Okay, and it formed this, I would call this a double bottom, but they're calling it a cup with handle here. I'd call it a double bottom with handle. And so you can see if you bought this gap up right here, you'd be feeling pretty good about it for a while. And it ultimately didn't work out. You might have got lucky and taken like a 10% gain, but I would have if you didn't sell for gains here, you would have had to sell it somewhere down in here as it closed below the low for the day. And then here's another gap move, which I actually bought this. I own the stock right now. I bought this day because it broke out of a second stage cup with handle, or double bottom with handle, and the stock has strong fundamentals. I like the chart. So I'm still holding this, and you can see it really hasn't done much since then. It actually has traded. You can see it did actually trade below the low for the day. Actually, this day right here. Actually, I'm sorry, I didn't buy this day. I bought the stock right here, this pocket pivot. So it really hasn't done much since then. But anyways. This was an example one you would have bought. If you would have bought this, you would have had to sell it. Probably I would have sold it the next day actually. And then since then it hasn't really done much. And that's despite the fact that the gap move was good, volume was very strong. It made a new high in price. But sometimes they don't work out. So that's why you got to have a stop. You got to have a defensive strategy to sell these things. Okay, so let's move on to, we'll do a market analysis, and then we'll do look at a couple recent trades. All right, let's start with the monthly chart of the NASDAQ. So you can see the NASDAQ is trading near all-time highs, if not at an all-time high, which coincides with the high price from March 2000. This was the the technology, the internet technology climactic action in the market. So we're trading near that level, and you can see that we were in a really nice uptrend here for a long time, since March of 2009, after the financial crisis. And ever since then, it's basically been trading in this box right here. You can see the lower range is defined right here, and then the top is right here. So this is a relatively narrow range of trading we've been in since for about a year now. The past month, so the month of August, you can see a relatively tight range there, and didn't really do much. Pretty uneventful. On a weekly chart, you can see, again, we're trading right near this all-time high where we hit resistance before. We could be doing that right now, or we could be, it could just be consolidating gains and waiting to move higher. You can see that over the past 4 weeks, volume's been light. So this is tight trading in light volume. That's generally constructive. But we're also not making a new high here. So kind of I have mixed feelings on the market right now. And on the daily chart, you can see over the past month, we were trading above the 10-day for quite a while here, and now we were trading just below it. Now it's kind of chopping around that. Again, we're above the major moving averages. I don't see any major. I think the only major resistance level we would see right now is that 52.30 level, which was the prior high. Support-wise, I would expect support. Probably 5,000 is a good support level right now. 50-day moving average. So overall, I'd say the market's okay. All right, let's look at just a couple stocks here I want to point out. Acacia Communications, I pointed out last month. We did a simulation on this. One thing I want to point out here is that out of this IPO base, you can see the stock's up 163%. Made a huge move. And just this 1 week alone, the stock was up 50%. Okay, this is the week I bought it. So this pattern here, if you look, the stock has moved up over 100% here in about let's say a 6-week period. And now you can see that we had this week where it pulled back a little bit, closed in the middle of the range. Last week it closed up in slightly above average volume. This pullback right here was about 20%. So this stock could be forming what's called a high tight flag, which is a rare chart pattern. I can't say I've seen one in the past 2 years. I think this is the only one potentially. In my book, this is nearly formed one here. We need like maybe one more week where the stock closes between 125 and let's say 100 here, and then I would say this is a valid high tight flag. This is a very bullish chart pattern. Qualcomm formed one of these in the late 90s. Tesla formed one in the mid 2000s. So keep an eye on this. If this thing consolidates here for another week and then breaks above this 125 mark, particularly in heavy volume, that would be a fine place to take a new position or to add. In fact, I'll add to my position if it does that. Okay, so a couple recent trades I want to point out here. TPI Composites. I've been watching this stock since it's gone public. You can see it has went IPO'd at $11, and it's traded above $11 since day one. They had an earnings report very shortly after going public right here. That's pretty unusual to have an earnings report 3 weeks after going public. But you can see when that happened, the stock gapped up. Volume was heaviest volume day since the IPO day. And then it was followed up with some heavy buying right here. Okay. Then the stock pulled back here in very light volume. I mean, see how volume here just died. This is a volume dry up day. These two here, or a voodoo day, as Gil Morales calls them. So I was watching the stock throughout this pullback, and I thought I think this is a nice candidate for a swing trade. So I bought the stock early in the day on this day, when it was clear volume was going to be heavy, and it had just broke through the 10-day moving average. And I set a 10% profit goal, which ended up getting triggered on this day. So this turned into a day trade. But this was a nice move here. You can see it was up 17% in one day. So I did that. I could still be holding it, but I chose to make this a swing trade. It hasn't formed a base yet. This move here, this here wasn't long enough, I would say, to be called an IPO base. And this is straight up from the bottom, which is more failure prone. So I chose to make this just a swing trade, took a 10% gain in a day, and moved on. And you can see it's pulling back here. Volume has been lighter than on these blue days. So I think this is a good one to keep an eye on. You know, you could keep an eye on and say if it breaks above this 21 level, you could give it a shot for a swing trade. Or if it bounces off the 10-day in heavy volume. Another swing trade that I made recently was Urende. This stock's very volatile, so I don't particularly like the idea of holding this stock for more than a few days. But this stock came down, and you can see the stock has held the 50-day moving average pretty much since it was established right here. It held it right here. It held it right here. So I thought if this thing hits the 50-day moving average, it is likely to find support at it. Okay? And if it doesn't, then I know to sell it as soon as it drops below it. So when I saw this pulling back right here, you know, this stock made a huge move, so a pullback was kind of inevitable. When I saw this day here, I thought if this thing hits the 50-day and starts to come off of it, I'm going to buy it for a swing trade. So I did buy the stock this day and ended up selling before the day ended. So this one turned into a day trade as well. So, and you can see there was more gains to be made here. I mean, if you bought it really at the low 22, you could have ridden it up to almost 30 if you got lucky. So that's a huge move in only a few days. But I like 10% profit gain on a swing trade, so that's what I did. And then I didn't try it again here, which I was glad I didn't, because you can see it closed below this. But if it comes back up through the 50-day, you can see it's finding support here around 20. So if it comes back up through the 50-day in heavy volume, it could be a good one for I think for another swing trade personally. So we covered Acacia Communications. What else here? Another one I'll show you is Pi. I like new issues, so that's why I'm covering a lot of these. This stock has been on my watch list, and you can see this stock would have driven you crazy if you bought it, because if you'd have bought here on this breakout from the IPO base, you would have probably had to sell it the very next day as the breakout failed. Then the thing breaks out again the next day, so you could have bought it again, goes up a little bit and pulls back and fails again. Alright, then this day it breaks out yet again, and this time it actually worked. Although this was, you know, I was watching this stock, and this was occurring right before the very first earnings report. And I thought, that's too risky for me. I don't want to do that. Although you can see that I'm regretting that decision now, because this was a pocket pivot day. It broke back above the 10-day moving average. This pullback here was pretty mild, and the stock gapped up here. This was a good gap up move here. You can see it gapped to a new price high. It closed high in the daily range. volume was massive, and you can see it followed up with even a bigger move there. So this stock has a lot of power. I chose not to buy this one because I didn't love the earnings growth here was negative. And you can see for this year earnings growth is negative. But for next year they're forecasting a big increase in earnings. So sometimes these stocks that have a large projected increase in earnings the next year sometimes those ones will perform really well because institutions are anticipating this increase in earnings in advance. So this is another good one to keep an eye on. I'm going to just keep an eye on this one now. I'd like to see it form another base. It formed this IPO base and it kind of chopped around before breaking out. But I'd like to see this form another base, and I might give this one a shot. It's got a high price for a new issue. It's got decent liquidity, decent trading volume. And then one more recent trade I'll follow here is Dave & Buster's. So Dave & Buster's is forming a cup base. It's a first stage base. It has mostly formed above the 50-day moving average, and it's all formed above the 200-day moving average. I bought the stock here on this day was a pocket pivot, broke above the 50-day moving average on heavier volume than the prior 2 weeks. And you can see since then we've had some accumulation here. This was a support day here, support at the 50-day, and then this day was up. I'm watching this trend line for this is my B1 here. I took half a position. I'd like to do my B2 when it breaks this trend line. However, this thing does report earnings tomorrow, so I don't normally buy stocks this close to an earnings report, but I'm trying to get a little better at this, where sometimes these stocks will give, let's say, if I like a 5% cushion going into an earnings report. Sometimes these stocks will give you that in a few days. So I'm going to try to do a little more of this lately. Maybe not be so afraid to buy a week before the earnings report, just to see if it gives me a good profit cushion. And if not, then I can sell it before the earnings report. So I'll make a decision on this one tomorrow, whether I hold this through the earnings report or not. But you can see the last earnings report, we had a gap up, okay, which ultimately didn't hold, but we had a gap up there. This day didn't really do much. This one this one gapped down, and it looks like it was up and then ended up trading just up, finishing just up for the day. We had an up day, a gap up move here. We can't really see it, but this stock, the bottom line is this stock hasn't had a gap down in an earnings report in the past year and a half. So I'm inclined, especially, particularly if I have like a 5% profit cushion at the end of the market close tomorrow, I will hold this through the earnings report. Right now, I'm on the fence about this one. On the earnings report, I would love to see a gap up move above this $50 mark in heavy volume. If that happens, whether I sell this tomorrow or hold it, I will either add to my position or I'll probably buy it back. Okay, so that concludes the market analysis and some recent trades. Let's wrap up here. Okay, as I mentioned in the beginning, if you found this video on YouTube and you're not a member of the Meetup group, you can join by following the below link. You do need a free Meetup account, and it only takes a few minutes to set that up. And if you're wondering why you should join, files like this presentation and cheat sheets, etc. are available to members only. You will also be notified when a new file or video is posted each month. So if you're not a member of the group, you can join right there. If not, you could subscribe through YouTube, and I think that'll also notify you if a new video is posted. You just can't download these presentations like this. Had a few questions from the past month from members, so I'm going to cover those here. First question, was about participating in the monthly meetups from a remote location, not being Pittsburgh. So I looked into this a bit so far, and I can tell you that the meeting location that we use is a public library, and it's not very well equipped for remote participation. The Wi-Fi is not stellar, and we've had issues with it not working at all a couple times. And I did actually ask IBD if they would let me use their GoToMeeting service so that people could participate remotely. And I didn't really get anywhere with that. And the guy I was working with actually doesn't even work for IBD anymore. However, next month I'm going to include in the invitation, I'll include a link to a GoToMeeting, and we'll give this a shot. And let's see how it goes. A free subscription to GoToMeeting only allows 3 participants. So that's what it'll be limited to. And if anyone is available to participate, we'll give it a shot. All right, the next question is, what is the best way to learn to read charts and recognize common chart patterns? So here's a couple things that helped me improve my chart reading. One way is to look at the mini charts in IBD Weekly. If you go to the IBD 50, for example, you can look at a mini chart and don't look at what's written there. Don't look at the commentary from IBD and make your own determination. So what do you think that chart is? Do you think it's a cup with handle? Is it a double bottom? Is it a flat base? And you could also just bring up the chart in your charting service that you use. You could use investors.com, you could use MarketSmith, whatever. But I like to read the chart, come up with my own determination, and then see what the mini chart says, and then compare the two. Another thing you can do is find out what stock they're covering in the IBD stock analysis videos. They have 2 of those per week, I believe. And do the same thing. Read the chart, maybe write down some notes about what you see and what you think, and then go watch the video and see if you saw the same things that IBD finds, and see how your findings compare to theirs. Finally, one more thing I'll recommend is that Bill O'Neill's most recent book, that's How to Make Money in Stocks. It's the green book. It's a green cover. He has a bonus chapter in there that's titled Test Your Knowledge, and that contains blank charts where you go in and you analyze the chart. You look for chart patterns, and then you write down your own notes on them, and then you can compare that to Bill O'Neill's commentary on the chart. So those are just some ways to improve your chart reading. And one thing I'll note is that chart reading is really, I'd say it's equal parts art and science. It's not, there's not necessarily a right or wrong answer when reading charts. And the last question was about staying in sync with the overall market. And how do you best do that? So I definitely agree, reading the market pulse every day is a great way to stay in step with the overall market. And that's one of, I think, the highest value things that IBD offers, is a simple market wrap-up each day. What happened? How much distribution have we had recently? Are we in an uptrend? Are we in a downtrend? Are we going sideways? They also have a market wrap video each day on IBD videos. And that's another, even if you read the market pulse, I would watch the video because they cover different things. And if you want more than that, there's actually a lot of people out there that do a free daily analysis of the market. A website called Virtue of Selfish Investing is run by Gil Morales and Dr. Chris Katcher, who I mentioned earlier. They have a free service. They call it a market lab report. That's I've never seen it. I've never used it, but that's just another option there, a free summary of the market action. And then there's another meetup group, the Thousand Oaks, California group, where one of the members, his name is Jerry Samet, he provides a daily market update free to all the members of that group. So if you join that meetup group, you can get Jerry's commentary each day. I wouldn't get more than like 2 of these personally, because you'll get, I think, too much information. I personally just look at the market pulse and the market wrap, but there's some other options here as well. All right, that concludes our meetup. Next month, we'll do a quarterly review, and I'll show you how to do that, the results of my quarterly review, and mostly we'll talk about reflecting on the results of your trades from the past quarter and coming up with an action plan for the next quarter. So if you have a suggestion for a future topic, please send me a message, or if you have any other questions, send me a message on Meetup. I read all my emails from Meetup and I respond to all of them. So that's the best way if you have a question or something. All right, thank you, and I'll see you next month.